Over the last 3 decades, today's guest has been relied upon by business executives, financial advisors, and investors around the world. He's appeared on Good Morning America, PBS, CNBC, and CNN Finance. In fact, you may have read his commentary in Barron's, Investors Business Daily, Entrepreneur, Fortune, U.S. News & World Report, The Wall Street Journal, or Omni. In fact, he's a regular guest on Fox Business's Nightly Scorecard and has written numerous books. In Harry Dent's 1992 book, The Great Boom Ahead, he had very little company as he accurately forecasted the unanticipated boom that defines that economic era. That same year, he also authored 2 consecutive books, The Roaring 2000s and The Roaring 2000s Investor. If you read his 2004 book, which included 20 years of forecasts called The Next Great Bubble Boom, you may have been prepared for the 2008 economic and financial collapse. In fact, back in 1989, this week's guest warned that Japan's collapse was inevitable. And in the 1990s, he nailed the rise and fall that was the dot-com bubble. I was following his work in 2006 when he warned a housing bust was on the horizon. And in 2008, those that listened may have been able to save a lot of grief by successfully positioning themselves for the credit collapse and collapse in equity values. So it's no surprise that he was right on these forecasts because he's a Harvard-educated economist, author, and publisher, and highly sought-after speaker. Harry Dent also has a popular newsletter with over 300,000 subscribers. We'll be grilling Harry today to better understand his methods, what he forecasts for the income generation specifically, and hopefully have a little fun discussing what all of you individually can expect within your own households. Harry, welcome to the show.
Nice to be here.
Great to have you. You say that governments are fighting unprecedented demographic and debt trends that could only be fought so long with artificial stimulus and this thing we call quantitative easing. Harry, give us an idea of these trends that you're observing.
Well, first of all, the baby boom generation around the world, largest generation in modern history, dwarfs the generation before it and somewhat the generation after it. So it first peaked in Japan in the late 80s. We were the only people that saw that because we have a spending wave, peak spending at age 46. We moved forward the birth trends for then until when a generation is going to spend and not, and it told us Japan was going to dive in the 90s just when people thought it was going to take over the world. And Germany has the worst trends today in Europe, and nobody's going to see that coming. But the United States peaked in 2007. We predicted that 20 years in advance. Baby boomers would peak, the spending momentum would go down, and we've had quantitative easing ever since in 2008 forward. So that's number one. Demographic trends are peaking in one country after the next around the world. Europe is the next to get hit hard. And then debt, twice the debt compared to GDP that we had in the Roaring 20s bubble. Only happens once in a lifetime, and debt causes financial asset bubbles. So these things have to burst. And of course, the last time they did, we got the 1930s.
Of course. Now, it's funny you mentioned Germany, because if that's true, then that doesn't bode well for the euro. And then you also mentioned, you told me that the issue that China's facing right now could even be far worse than that. So tell us.
First of all, China's the only emerging country, because they have all the demographics in the decades ahead, all the demographic growth. China is the only emerging country that actually their workforce is already shrinking slowly since 2012, and after 2025 it falls off a cliff like Japan. And China has the greatest bubble I've ever seen in modern history. They have overbuilt 27% condos empty in major cities, whole cities of 1 million plus, nobody in them. You know, railways, roadways, bridges to nowhere, and the biggest mall in the world is empty, and they turned it into a tourist attraction. So they've overbuilt everything, move people massively. China is the greatest bubble I've ever seen. If it doesn't burst in the next 4 to 5 years, I will move to Australia and become a limo driver and quit economics. I mean, it's that obvious to me.
Interesting. Now, how about the dollar and gold? You expect the dollar to rise, and you expect gold to drop, which is kind of going to surprise all the gold bugs, because most people say, and I'm sure you've heard this, that gold does well during times of financial crisis. So tell me your view on that.
The biggest financial crisis we had recently was in the second half of 2008 when the whole system blew up.
Of course.
Gold went down 33%, silver 50%, commodities down, real estate down, stocks down around the world. The only thing that was up was the U.S. dollar and the highest quality bonds. So the gold bugs are wrong. I've studied gold back to the 1600s. Adjusted for inflation, it does not appreciate. And it makes no income like real estate, which also does not appreciate long-term adjusted for inflation. So gold is an inflation hedge, correlates beautifully with inflation. So the 70s was the time to own gold. We're moving into a deflationary period, which always follow these financial bubble and debt bubble burst, because money's destroyed. I mean, literally trillions of dollars will be destroyed. And so deflation does not favor gold. So I have more bets with gold bugs than you can imagine. I'm winning all of them at this point.
Yeah, you and I definitely agree with all those terms, deflation over inflation, looking forward and so on. Now, another place where we agree, which is very interesting, is, and I'm sure we agree, but for different reasons, as is normally the case between us, you predict that we can very well see a Dow Jones Industrial Average down around 6,000 or so. And I'd like to hear your side of this and why you believe so strongly that that's likely to happen probably by 2017, I think you said.
Yeah. I mean, there's a pattern that is so obvious nobody's seeing it because nobody wants to see it. I call it the megaphone pattern. And we had this, stocks peaked in 65, 68, and 72, 3 peaks higher and 3 crashes lower. And it ended with the horrible 73 to 74 crash. So the Dow peaked in 2000, then it peaked higher in 2007, and now higher in 2015. But each crash has taken us to lower lows. This pattern says it's peaked. The final, you only get 3 of these. And then this final peak will take us in the next year or two down to about 5,500 to 6,000. So that's just a really good guess. You can only guess in the short term. I can make incredible long-term predictions. That's easy. But that's my most likely scenario, a bigger crash. And people always say, oh, Harry, that's too bearish. I think we just saw 6,400
of course
in early 2009 and 2 big crashes. And people are telling me this can't happen after 6, 7 years of total artificial stimulus. How can you ever have a sustainable economy on free money created out of nowhere?
Mm-hmm. And isn't it also true that in every one of these long-term bear markets we've ever had, we've always had at least 3 major drops? We've never had one with just 2?
That has been more typical. In the Great Depression, we had 2 major drops. Actually, when you go all the way to early 40s, 3s, that is typical. And when you see after bubbles, the typical bear market is 80%, not 50 or 60. In Japan, their peak to bottom is 80%. And again, I keep telling people, look at Japan, their baby boom, they had a real estate bubble, a stock bubble way before the US and Europe, because their baby boom peaked just before and after World War II. So way ahead. Now the US is following, and people say, oh, real estate will come bouncing back. No, it hasn't bounced back in 24 years in Japan, and it went down 60%, and commercial went down 80%. Real estate will never be the same when the next generation does not replace the baby boomers in size and numbers of people. Net demand is going to go down for decades. So real estate's not going to come roaring back.
Of course. Now, what's interesting is you and I, as you well know, have agreed with each other over the years on most topics. And the one place that I disagreed one time was back in the very, very late 1990s. I was predicting myself that we'd be slipping into a bear market cycle. And at that point, you were talking about a Dow possibly at 30 or 40,000. And I know shortly after that, you must have gotten some intelligence, some research that got you to change your prediction and be more in line with mine. Tell me what made you change at that time.
Yeah, we have an 80-year cycle, 2 booms, 2 busts, an inflationary crisis and a deflationary crisis. I call it spring, summer, fall, winter. And so we look back at the last fall season, which was in the early 1900s into the roaring 20s, and there was a first tech bubble, and then it crashed massively, just like in the early 2000s. And then there was a second one that was even stronger. So I was expecting that to happen again. And then, so we got into that. We told people to buy stocks again in October 2002, right at the bottom, literally right at the bottom. But I thought stocks were going to bubble up even more. And what I had to do about halfway up that, I said, something's wrong here. We're not seeing it. It's still a bubble. Stocks double, but we're not seeing that strong bubble. What was different in the roaring 20s? I came up with 2 new cycles, a 30-year commodity cycle, killer accurate, and a geopolitical cycle, which is so important today because this said 83 to 2000, great geopolitical environment. Nothing went wrong in the world, but 2001 to now and for the next 4 years, horrible.
And Harry, we need to take a quick break, but as soon as we get back from that break, we're going to ask Harry more questions about his predictions, almost all of which have come true, so don't go anywhere. We'll be right back.
「 Harry Dent, 20 years ago, he said, 'We're going to have a great year.' And he said, 'We're going to have a great year.' And he said, 'We're going to have a great year.' And he said, 'We're going to have a great year.' And he said, 'We're going to have a great year.' And he said, 'We're going to have a great year.' And he said, 'We're going to have a great year.' And he said, 'We're going to have a great year.' And he said, 'We're going to have a great year.' And he said, 'We're going to have a great year.' And he said, 'We're going to have a great year.' And he said, 'We're going to have a great year.' And he said, 'We're going to have a great year.' And he said, 'We're going to have a great year.' And he said, 'We're going to have a great year.' And he said, 'We're going to have a great year.' And he said, 'We're going to have a great year.' And he said, ' Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
We're here with world-renowned economist Harry Dent, and we're talking about, first of all, your new book, and we're also talking about some of the predictions you've made, past, present, and future. Now, just before the break, you mentioned that one of the things that got you to change your prediction in the late 1990s going into the early 2000s was geopolitical considerations. So could you talk just a little bit more about that for a moment, please?
Yeah, there is a geopolitical cycle that I've now tracked back 200 years. And it's 17 to 18 years positive. Example, 1983 to 2000, nothing went wrong in the world of any significance. 2001, 9/11 to now, everything's gone wrong. Right. And we've got 4 more years in this down cycle. Stocks are valued at 50% less in the down cycle of this. So if I'd have had this cycle in the late 90s, I would have been predicting a Dow of 16 to 20,000. I would have cut that in half because of this one cycle. It's a very powerful cycle, and it continues. The Middle East and everything we're seeing today is not going to get better for at least 4 more years, until at least early 2020.
I have to agree with that. And of course, that 16 to 20,000 point Dow range is exactly where we are today, which makes sense to me. You also mentioned the 30-year commodity cycle was something else that you discovered as a result of the tech bubble bursting, before you had thought it would happen. Tell us about that.
Yeah, in the Roaring 20s, that final bubble that I was kind of looking at, commodity prices were falling. In the 2002 to 2007 bubble, commodity prices were rising, in fact, very strongly. So rising commodity prices are not good for earnings and not good for the economies of developed countries. And the collapse of this commodity cycle, again, it's right on 30 years, 1920, 1949 to 51, 1980, and then now a double top 2008 and 11. I mean, right on 30 years. Emerging countries are greatly underperforming the global markets because commodities are collapsing, and that's the business they're in. They are commodity exporters.
Interesting. Very
Except
interesting.
for India, and that's why India is doing well when everybody else is not.
That's awesome. I love that. I learned so much from you over the years, which makes this, just really makes it enjoyable having you here today as a guest. Now, I know that most of what you do tends to be based around demographic trends. The question I have is really simple. How do you see that being affected by immigration, by refugees into the United States? How is that going to make things different?
Well, immigration is huge for countries like the United States, and even more so for Canada, Australia, Singapore, and countries like Switzerland. These are some of these smaller countries, the only ones that have a larger echo boom than the baby boom. So I actually calculate in my birth index, which I moved forward 46 years for the peak in spending, I calculate in all the legal and illegal immigrants, past and future forecasts, because I can take a computer model and say this is when they were born. Right. So they are in that index. Immigration has a huge impact on demographics, just like births. In fact, even better, because immigrants come in working age, ready to go. Kids you have to raise for 20 years before they enter the workforce on average. Got it. So they're a cost, not an asset at first.
It actually makes sense. It's funny. I watch all the talking heads on television. They're spouting out numbers. And what you say to me is just common sense. It just makes sense to the average person who's listening. Now let's talk about your book. In the demographic cliff, you speak about spending patterns at different ages, stages of our lives. What are some of the key times and turning points that you find as we grow throughout the years? Well,
workforce entry, age 20. On average, some at 18, some at 22 college, but 20 on average. That's when inflation, the cost of raising these kids, the biggest factor in inflation is people, not monetary policy. Milton Friedman was wrong on that one. And so then they start this great spending, and they get married and have kids and stuff. And so they'll spend the most money on child care, 33, but they'll buy their first home, 31. They'll buy their biggest home, 41. They spend the most money at 46. That's the next big turning point. But for the affluent, who are still spending after 2007, when we said overall the economy would peak, the most affluent 20% drive 50% of consumer spending now, and they don't peak until 54. They go to school later, their kids go to school later, their whole family cycle is later. And because of the high income inequality, because QE is raising stocks, these people are doing very well. But my big surprise, other than Germany, as we said, and China falling, The U.S. affluent sector is going to take a dive in 2016, as are auto sales, which has been the strongest sector. Auto sales peak at age 54 and then drop like a rock. Nobody's going to see this coming.
Well, I'm glad to hear I'm past my peak spending years. That's good news. It can be a little bit easier on me from this point forward. You know, tell our viewers for just a moment, in the demographic cliff, tell them 2 or 3 things that they are going to get, that they are going to learn, that they could take home to manage their own personal finances in what you and I both perceive to be a much wiser way.
Well, again, what we say is we can tell people the key economic trends that are going to impact their life, their business, their family, their investments over the rest of your lifetime. Long-term trends are easy to predict. What the stock market's going to do next week or month is very difficult, and I can only guess. And if I'm really good, like October 2002, I say buy stocks here. You know, I can be right maybe 2 out of 3 times, but long-term is different. So demographics is key. We predict inflation on demographics, not on monetary policy. Who knows what the Fed's going to do 5, 10 years from now? I know when people are going to enter the workforce, and that correlates with inflation better than any indicator. We predict the spending, when generations are going to spend more and not any country in the world 4 to 5 decades in advance. So we can tell you, for example, 1983 to 2007 was the baby boom boom, and we always said this will be the greatest boom any of us will see in our lifetimes, because the next generation is nowhere near as steep or does not go as high. The next great boom in the world, we look at the emerging world. India is the next big thing, almost guaranteed, unless they just totally screw it up politically, and they're moving in the right direction for once. China is not going to see the same boom they saw. India is going to be the one large country that's going to grow, and Southeast Asia and India and that part of the world is going to be the center of the world for the next decade.
So when I look at this just in the last 60 seconds or so we have today, you know, first of all, it sounds like you're saying don't run out and buy the new home, buy things today, because we're in a deflationary cycle. Cash might very well be king at some point down the road, correct? Great. And it sounds like you're also saying that as far as the stock market's concerned, be careful. At least at bare minimum, have one finger on the trigger, because there is another major drop, whether it's 2016, 17, or 18. We don't want to get pinned down. You're too smart for that. I get that on the time frame. But at bare minimum, to warn our viewers of the fact that you need to be careful about the stocks you hold, and especially, it seems to me as if you need your money in the next 10 years or so, you want to be really cautious and have one finger on the trigger and not get greedy, because the old saying, pigs get fat and hogs get slaughtered, right?
Exactly. Cash and cash flow are king in what I call the winter deflationary season. None of us have seen that. The last one was the 30s, so people don't understand. Asset allocation doesn't work in the winter season when all bubbles burst except the safest bonds and currencies.
That's right.
And also bubbles, when they burst, and we just saw it in China, and we saw it in 1929, 40% down, 42% down in the first 2.5 months. Half the whole 80% move was made in the first 2.5 months. You're better to get out a little early and give up that last 5% than to wait until it's obvious, because bubbles burst much faster than they build.
That's perfect. You heard it straight from the mouth of Harry Dent, the author of The Demographic Cliff. We'll be right back.